What the heck is going on with banks? So unless you've really lived under a rock the past bunch of weeks, you've noticed a bit of a issue in the banking sector. So I guess the question on everyone's mind, and I've been addressing a lot with clients, is why the sudden issue? What's being done to stop it? What should you do? And again, is this '08? So let's start at the top. Why the sudden issue? Or maybe not so sudden. So there's really two main factors that have come into play. One is a lot of these banks are very concentrated. SVB, Silicon Valley Bank, and Signature. Signature was big and heavy concentration in cryptocurrency, and SVB, Silicon Valley Bank, was heavily involved in the tech sector and venture capitalists and startup world, of which 90% of their client base had over 250,000 in deposits. So why does all this matter? Well, at the end of the day, even the name of our company is Diversified. These were sort of mid-level banks that were not diversified in their client base. For instance, SVB, that through interest rate issues last year and tech sector, got beat up. Their client base, their customers, the tech sector, startup sector, was really struggling. And what happens is a lot of them were starting to withdraw cash at a much heavier rate than they needed to, or previously needed to, I should say. And this causes an issue, which leads to the second big component. So one is very unique businesses, and the other is interest rates. So these businesses were hurt. Of course, means you have to draw, when you're not as profitable, you have to draw more cash out of the bank. And the other thing is banks don't keep money sitting on the side. And it's not sitting in their bank. These banks don't have trillions of dollars sitting at a branch. What happens is they either lend it out, or very likely they go buy treasuries, which are considered sort of the risk-free asset, if you will. And why is that important? Because a year ago, treasuries were paying virtually nothing. So banks would pay your little piddly squat interest that you left there, and they would make a little more piddly squat at super low interest rates on the treasuries they bought from the Fed, and they would get that spread, and it would be profit to the banks. So let's fast forward. So a year goes by, high inflation, interest rates go through the roof. The Fed's raising, and what then happens is the Fed raised so much that it hurt certain industries, which was kind of meant to be done. But then the sort of the unintended consequence is now these industries were withdrawing funds at a very hefty rate, and concerned, which causes a run on the bank, meaning a lot of people pull out at the same time, and these banks don't have the subsequent cash on hand. So what do they have to do? They have to go sell treasuries. However, the treasuries they own are super low because they owned them by insuring all their deposits a year ago when interest rates were low. And to sell those treasuries, they have to take a loss on them because now new treasuries are paying much more. And sort of the relationship between bonds and interest rate is inverse. So when interest rates go up, your current bond goes down because who wants to buy a 2%, 1% bond right now when you can get a 5%, 6% bond? Again, through the government at a very low risk, or considered sort of risk-free. So this sort of convergence of issues, non-diversification in the banks, their industry getting hit hard, and then on top of that, the banks causing all these people to ask for their funds back at the same time, creating a run, causes these banks not to have the liquidity, and to create the liquidity, they have to lose money. That, by and large, is what happened. How do you stop it? Well, the short answer is there's really two main factors. One is the Fed, government, Treasury is stepping in to backstop over 250,000 FDIC insured on these banks, saying, listen, let's stop a contagion from happening. We're going to insure everything at the banks, which was a huge play. And then the other thing is the other banks step in. So these banks may seem somewhat large, and they aren't small banks, but they are substantially smaller than the big boys, the J.P. Morgans of the world, the Bank of Americas, which are massive, massive banks. So a lot of these banks are buying up their assets. They're lending money to some of these banks to backstop runs, so they have the liquidity needed and to prevent a contagion and a run on these banks. So you're really seeing those two factors really come into play here, which should stop a sort of a major issue in the banking and finance industry. So the next two questions. Is this '08? Short answer is no. '08 was misvalued assets, leveraged 5 times over, that took over the whole financial industry, and when they realized they were worthless, crushed that industry. And by the way, we got through that. This is not that by any stretch. So I wouldn't be overly concerned that we're reliving '08 again. The final question, what should you do? So I would tell you two things. One is, it's not a bad idea to do your due diligence on a bank. That said, it may be for naught. It's really hard to uncover this information from any bank, candidly. This is very nuanced stuff, and for the average depositor or individual to understand what risk their bank has is really, really hard to uncover. But I'm not telling you not to. It's good to ask the question. The other is, if you're really concerned, stay under the $250,000 limit. And remember, that's per registration. So husband, wife, and husband and wife together can have $750,000 just by changing a registration at one bank. If you have substantially more than that, or even more than $250,000, give me a call. We'll talk. But by and large, those are the main sort of tools in your tool belt to combat this. So not overly concerned, not to say it isn't concerning. No one wants to see banks fail. It does happen, and it looks like the appropriate parties are stepping in to contain it. As always, I'm Andrew Rosen, President of Diversified. Stay wealthy, stay healthy, and stay happy.